what a lot of us don't like is the vast stupidity with which parts of that social safety net are managed by the government. It'd be much better if we could do it more wisely. But I think it also might be better if we did it more liberally.
Yeah, one of the reasons we're involved in this effort, along with J.P. Morgan and Amazon, with Jamie Dimon and Jeff Bezos, on the medical question, is we do have as much money going, 3.3 or 3.4 trillion. We have as much money going to medical care as we have funding the federal government, and it's gone from 5 to 17% or 18%, while actually the amount going to the federal government has stayed about the same at 17%. So we hope there's some major improvements from the private sector, because I generally think the private sector does a better job than the public sector in most things. But I also think that if the private sector doesn't do something, you'll get a different sort of answer. And I like to think that the private sector can come up with a better answer than the public sector in that respect. But I will probably, it depends who's nominated, but I voted for plenty of Republicans over the years. I even ran for delegate to the Republican National Convention in 1960. But we are not, I don't think the country will go into socialism in 2020 or in 2040 or 2060. Okay, Greg Warren.
Warren, my first question, not surprisingly, is on share repurchases. Stock buybacks in the open market are a function of both willing buyers and sellers. With Berkshire having 2 shares of classes, you should have more flexibility when buying back stock. But given the liquidity difference that exists between the 2 share classes, with an average of 313 Class A shares exchanging hands daily the past 5 years, equivalent to around $77 million a day, and an average of 3.7 million Class B shares doing the same, equivalent to around 622 million. Berkshire is likely to have more opportunities to buy back Class B shares than Class A, which is exactly what we saw during the back half of last year and the first quarter of 2019. While it might be more ideal for Berkshire to buy back Class A shares, allowing you to retire shares with far greater voting rights, given that there's relatively little arbitrage between the 2 share classes and the number of Class B shares increase every year as you gift your Class A shares to the Bill and Melinda Gates Foundation and your children's foundations, can we assume that you're likely to be a far greater repurchaser of Class B shares going forward, especially given your recent comments to the Financial Times about preferring to have loyal individuals on your shareholder list, which a price tag of $328,000 of Class A shares seems to engender?
Yeah, we will, when we're repurchasing shares, if we're purchasing substantial amounts, we're going to spend a lot more on the Class B than the Class A, just because the trading volume is considerably higher. We may, from time to time, well, we got offered a couple blocks in history, going back in history, from the Yolshi estate, and when we had a transaction exchanging our Washington Post stock for both a television station and shares held by the Washington Post. So we may see some blocks of A, we may see some blocks of B, but there's no question if we are able to spend 25, 50, or $100 billion in repurchasing shares, more of the money is almost certainly going to be spent on the B than the A. We don't. There's no master plan on that other than to buy aggressively when we like the price, and as I say, the trading volume in the B is just a lot higher than the A in dollar amounts. Charlie?
I don't think we care much which class we buy.
Yeah. we would like, we really want the stock, ideally, if we could do it, if we were small. Once a year we'd have a price, and we'd do it like a private company, and it would be a fair price, and people who wanted to get out could get out. And if other people wanted to buy their interest, fine, and if they didn't and we thought the price was fair, we'd have the company repurchase it. We can't do that. But we don't want the stock to be either significantly underpriced or significantly overpriced, and we're probably unique on the overpriced part of it. But we don't want it. I do not want the stock selling at twice what it's worth, because I'm going to disappoint people. We can't make it. There's no magic formula to make a stock worth what it's selling for if it sells for way too much. We don't, from a commercial standpoint, if it's selling very cheap, we have to like it and we repurchase it. But ideally, we would hope the stock would sell in a range that more or less is its intrinsic value, business value. We have no desire to hype it in any way, and we have no desire to depress it so we can repurchase it cheap. But the nature of markets is that things get overpriced and they get underpriced, and we will, if it's underpriced, we'll take advantage of it. Okay, station 3.
Hello, Charlie Munger and Warren Buffett, my idols. I'm Terry from Shanghai Judge PE Fund, which aim to catch the best investment opportunity in next era. So my question is, as we all know, 5G is coming. It is said that the mode of all industry will be challenged in 5G era. So what is the core competence that we should master if Berkshire Hathaway wants to catch the best investment opportunities in next era? Thank you.
Well, there's no core competence at the very top of Berkshire. The subsidiaries that will be involved in developments relating to 5G or any one of all kinds of things that are going to happen in this world, the utility of LNG in the railroad, or all those kinds of questions. We have people in those businesses that know a lot more about them than we do, and we count on our managers to anticipate what is coming in their business, and then sometimes they talk to us about it. But we do not run that on a centralized basis. And Charlie, do you want to have anything to add to that? Do you know anything about 5G? I don't know. Well, you probably know a lot about 5G.
No, I know very little about 5G. But I do know a little about China. And we have bought things in China, and my guess is we'll buy more.
Yeah. But, I mean, we basically want to have a group of managers, and we do have a group of managers who are on top of their businesses. I mean, you saw something that showed BNSF and Berkshire Hathaway Energy and Lubrizol all there. Those people know their businesses. They know what changes are likely to be ahead. Sometimes they find things that they can cooperate on between their businesses, but we don't try to run those from headquarters. And that may have certain weaknesses at certain times. I think net it's been a terrific benefit for Berkshire. Our managers, to a great degree, own their businesses, and we want them to feel a sense of ownership. We don't want them to be lost in some massive conglomerate and where they get directions from this group, which is a subgroup of that group. And I could tell you a few horror stories from companies we bought when they tell us about their experience under such an operation. So the world is going to change in dramatic ways. Just think how much it's changed in the 54 years that we've had Berkshire. And some of those changes hurt us. They hurt us in textiles. They hurt us in shoes. They hurt us in the department store business. Hurt us in the trading stamp business. These were the founding businesses of this operation. But we do adjust, and we've got a group overall of very good businesses. We've got some that will be actually destroyed by what happens in this world. But that's, I still am the card-carrying capitalist, and I believe that's a good thing. You have to make changes. We had 80% of the people working on farms in 1800. And if there hadn't been a lot of changes, and you needed 80% of the people in the country producing the food and cotton we needed, we would have a whole different society. So we welcome change, and we certainly want to have managers that can anticipate and adapt to it, but sometimes we'll be wrong, and those businesses will wither and die, and we better use the money someplace else. Okay, Carol. Sure, you haven't had any peanut brittle lately. I mean, you're not.
This question comes from Vincent James of Munich, Germany. There has been a lot written about the recent impairment charge at Kraft Heinz. You were quoted as stating that you recognize that Berkshire overpaid for Kraft Heinz. Clearly, major retail chains are being more aggressive in developing house brands. In addition, Amazon has announced intentions to launch grocery outlets, meaning that, as Mr. Bezos has often stated, your margin is my opportunity. The more fundamental question related to Kraft Heinz may be whether the advantages of the large brands and the zero-based budgeting that 3G has applied are appropriate and defensible at all in consumer foods. In other words, will traditional consumer good brands in general, and Kraft Heinz in particular, have any moat in their future? My question is, to what extent do the changing dynamics in the consumer food market change your view on the long-term potential for Kraft Heinz?
Yeah, actually what I said was we paid too much for Heinz. I mean Kraft, I'm sorry.